Hi, Assalamualaikum. So I'm gonna start with the introduction of IFSB-14. For the background, the Islamic Financial Service Board (IFSB) is an effort to guide the Takāful, which is Islamic insurance industry, to a stable and sound financial environment. Published its first two standards on Takaful in December 2009 and 2010. In 2006, issue paper published by the IFRS and the International Association of Insurance Supervision (IAIS), the major issues facing by the Takaful industry were identified and grouped into four main themes, which are corporate governance, financial and prudential regulation, transparency reporting and the market conduct, and the supervisory review process. Okay, next is this standard is intend to establish minimum standard in the area of risk management for the direction and the guidance of Takaful operator (TOs), and as well as insurance or Takaful supervision. The standard discuss how management of risk inherent in the TU should be implemented. Next, I will continue with the general principle. Following the approach taken by the IFSB Article of Agreement, this document set out minimum standard to be applied to the Takaful industry, in parallel with the perspective set out by the IAIS in order to bring the Takaful industry to the desired level of effective supervision and regulation at par with the conventional insurance industry, subject always to the requirement of Sharia principle. This standard has been designed to articulate principles that may be applied to a variety of circumstances and does not prescribe a specific qualitative standard. This is for practical reasons, difference in the environment in which different TUs operate, as well as the difference in their operational framework. Mean that a detailed prescription that might be calibrated to suit one entity would not necessarily be suitable for others. Alright, there are three main objectives. The principle and the recommendations set forth in this document are intended to achieve the following main objective. First is to help understand the risk to which a TU is exposed. The second one is to provide minimum standard for the development of a risk management framework to ease for management of the TU and the supervision by its governing bodies and the supervisory authorities. And the last one is to help create a safe and prudent environment for the growth, sustainability and development of Takaful industry. Alright, moving on for the scope of application. This standard is applicable to all TUs operating under family Takaful, general Takaful and composite Takaful license. The standard is also intended to be suitable for application to the Takaful Undertakings, to Takaful windows of other financial institutions, or to the other type of institution providing insurance function or models according to the Islamic principle. In each case, with such modification as may be necessary to reflect a difference in their operational framework compared to the TUs referred to at the commencement of this paragraph. This standard focuses on the risk management principle of individual Takaful undertaking. In the case of group of company, the principle may set forth in this document may also apply with the suitable modification and developing and supervising a group-wide risk management framework in respect of a group Takaful operation. Okay, next is the specificities of Takāful undertaking relevant to risk management. TUs aim to uphold the principle of Sharia in providing for pooling of risk of the participant. Next is TU shares some similarities with the conventional insurance in that both involve pooling the risk exposure of a group of participants to specified uncertain further event with the objective of providing assistance to those who are exposed to the occurrence of those events. In particular, TUs resemble in this respect conventional mutual or cooperative insurance undertaking in which the policyholders are collectively the owners of the fund and therefore provide insurance to one another, bearing the insurance risk collectivity, albeit through the medium of a legal entity. TUs that are constructed as hybrid entity, which an operator also differ from conventional mutual in various respects. This may affect the incidence of the risk to undertaking because of the application of Sharia principle. The risk management framework established by the TO for the TU needs to take into account the relationship between the stakeholder based on the application of Sharia principle.
For the risk, first risk is international standard on the risk management in insurance. IAIS give a guide on the risk management to conventional insurance. IAIS also highlight the rules and the function of the risk management at the different level. The TU acts as a IAIS member, and the national regulatory system is required to represent the ICP. Subject always to conformity with the two principles in the case of a framework embodying the Sharia principle. The ICP set out the requirement for supervisor. First requirement is a requirement for a insurer to have as a part of the overall corporate governance framework, emphasis instead of risk management and internal control. Second requirement is interpret risk management requirement for serve purpose that requires insurer to address all relevant and material risks. The additional requirement of the IAIS material with regards to risk management requirement for insurance undertaking provide a framework for the activity. It also deals with concepts such as risk appetite and the on-risk and sufficiency assessment or RSA. Next, I will proceed to the second risk, which is a risk specific to Takaful undertakings. They have the three types of risk. First risk is risk of Sharia non-compliance. Second, risk arising from the segregation of funds. Third, a risk relating to the use of Takaful. First, risk of Sharia non-compliance. The US compare their conventional counterpart and also important for TU product development process. For that, it also relevant to the Takāful interpret investment function. For the second risk is a risk arising for segregation of funds. The TU needed the special attention is to different funds attributable to participants from each other and from those attributable to shareholder. TU cannot reduce a risk by differentiating funds attributable to different stakeholders. This can lead off differentiation leads to the higher demand for economic resources and possible increase competitive pressure on the TU. and also can introduce the possibility of the incorrect allocation of the transaction to a fund resulting in expenditure being borne of or profit. For the last risk is risk regulating to the use of the Takāful. It is the alternative risk transfer mechanism decided in IFSB-14, reinsurance and other form of risk transfer. The IAIS material require that supervisors set standard for reinsurance use and other form of risk transfer. Last but not least, the Takaful contract does not share the risk of carrying the TU with that of other TU, and the TO must consider that the contract is effective in mitigating in the risk. Thank you.
So today I'm going to talk about significant risks of particular relevance to Takaful. The specific of Takaful call for an understanding of which risks affect a fund. This standard provides an overview of risks from the perspective of the separate funds, highlighting the risks that may be exclusive to that individual fund. TOS should observe and monitor these risks as they affect the different funds at a minimum. So the following point refer to and adapt the requirements of IFSB 1. So the first one is operational risk. Operational risk is the risk of loss resulting from inadequate or failed internal processes, people and system, or from external events. So other than that, underwriting risk is the risk of loss due to underwriting activities relating to the participants' risk fund. Next is credit risk. Credit risk is the risk that counterparty fails to meet its obligation in accordance with agreed terms. Besides, liquidity risk. Liquidity risk is the risk of loss to a Takāful undertaking arising from its inability either to meet its obligations or to fund increases in assets as they fall due without incurring unacceptable costs or losses. Last but not least is legal and compliance risk. Legal and compliance risk is the risk relating to the legal and regulatory implications arising from TU as operational activity. So that's all from me. Thank you.
Today I will talk about the enterprise risk management in IFSB 14. Okay, first is general framework. Like any organization, a TU is exposed to risks that may affect its ability to achieve its objective or even its continuing existence. Next is a TO, in its capacity as manager of the participants' funds, should accordingly establish and review regularly a framework for managing the different risks of the undertaking. A TO should then reflect these policies in operational processes across the TU through design and implementation of controls, effective risk reporting, and systematic assessment of control compliance and adherence to policy. This standard describes as a basic structure for an effective risk management framework for a TU. It acknowledges the diversity of Takaful models worldwide. Okay, next is I will talk about the asset liability management. Asset liability management, known as ALM, is an essential part of the risk management framework, whereby the TU stability is evaluated based on the appropriateness of the matching of its assets and liabilities. There are 4 factors that may affect the ALM policies of a TO. First is separate consideration of constituent parts of the TU. This standard refer to the segregation of the different funds that constitute a TU. This segregation has implications for the availability of different ALM strategy for a TU. Since a TU may present fewer opportunities for benefits of scale, hedging and diversification of risk between a constituent parts compared with a conventional insurer. Next factor is risk affecting ALM. The TO should monitor the main risks that could cause mismatches between the assets and liability of the constituent parts of the TU. These risks include rate of return risk and liquidity risk as well as solvency risk. Next is growth and business direction. When determining or reviewing its ALM policies, the TO should consider actual and prospective changes in the level and nature of the TU's business. For example, a change in emphasis from protection product to offering investment-linked type of product would require realignment of investment strategies. Lastly, the external factors. While ensuring the ALM policies are consistent with the TO business plans, the TO also needs to monitor external factors such as the regulatory requirement of the Takaful industry. Okay. The next one, I will talk about the risk governance. Governance refers to the process and structure adopted by an organization to ensure that its policies are executed. Next, elements of the governance structure include the architecture of the internal control framework and the roles of key persons and bodies. There are 4 functions are described as control functions, being the risk management function, the actuarial function, the compliance function, and the internal audit function. Lastly, the Sharia board also has a governance function. This standard does not mandate particular titles or structure for function or officer. Thank you.
Today I will explain about the Own Risk and Solvency Assessment (ORSA), and I will explain about the transparency and public disclosure. Okay, for the ORSA, standard on solvency requirement for Takāful Islamic Insurance undertaking highlight to need for every TU to have its over risk and solvency assessment (ORSA) mechanism in place. TO, which is Takaful operator, will be required by regulation to have an ORSA process and to report the result periodically to the supervisor. The ORSA is a key aspect of the risk management system of a TU, which is Takaful undertaking. It is a mechanism by which a TO continually assesses based on its planned level of business and risk management framework. The ORSA involves challenging the TU current financial system and risk management framework via quantitative measurement of identified risk exposure in stress conditions. The output of the ORSA assists the TO in the early identification of weakness that may betray to business continuity. TO in forming an ORSA should take into consideration the separation of funds between the PRF, PIF, and SHF. This is to provide an independent review of the risk affecting each particular funds. The ORS covers all funds because although any losses in the PIF or PRF should not be borne by the TO, the ORSA for a TU also needs to take into consideration the potential impact transaction between funds and each particular of court or any other kinds of financial assistance that SHF will provide to the PRF. The TU ORSA is recommended to be conducted on a continuous basis under oversight of the risk management function and with regular reporting to the BOD. The TO should determine the overall financial resources needed by the TU as part of the ORSA process. Although ORSA is an internal initiative by TO to self-assess to risk profile and financial condition to the TU that is managed. TO conduct its ORSA may differ from another TO. The ORSA mechanism should be structured in such a way that it reflects its TU exposed to PRF, PIF, and SHF, its complexity and the risk appetite. As part of ORS process, a TO should conduct stress testing for all parts of the TU. Stress testing is normally conducted to determine the resolution of the TU. To should be designed or reflect the TU circumstance and risk profile. Besides, to choose must be appropriate to the nature of the TU activity. Although not all jurisdictions require stress testing, TO should perform stress testing as part of present risk management mechanism. And in ORSS report, senior management expressed with its reason its view on the appropriateness of the level of financial and other resources held. The ORSA report is subject to appropriate level of review and approval. The form and content of an ORSA report should be suitable for the circumstance of the TU. Okay. Next, I will explain about the transparency and public disclosure. Okay, for TO should disclosure for each funds and for each category of risk, a description of the nature of the risk, and second, information of the TU exposed to the risk include on consideration, mitigation, management, and sensitivities. Management opinion on the effective operation of the risk management framework. Information disclosure should be derived from systems and processes that are properly controlled and regularly assessed by the TO for effective operation. The information disclosure should be published after approval by or on behalf of the BOD.
I'll be presenting for the key elements in the supervisory review process of risk management for Takāful's undertaking. Now, in this section, as a part of its activity supervising, TUs, the supervising authority, will normally review the risk management framework established by the TO. Where necessary, the supervisory authority may direct the TO to strengthen the risk management framework. It is not normally the responsibility of a supervisory authority to give positive approval to a TU risk management framework. It is the responsibility of the board of the directors to ensure there is an effective risk management system is established and operated. They also must review its continuing effectiveness. However, the supervisor should consider whether there is evidence that this responsibility is not being adequately discharged. A supervisory authority may pay attention to the following matters, the key elements as in the key elements of the supervisory review process. So one of the key elements that is present in this is that there's 8 key elements, if I'm not mistaken. There is like the existence and operation, a framework of a good work, the qualitative aspects of risk governance, the effectiveness of risk management processes, that's important. 4th is the fund separation issues. Next is the relevance test to the TO, and clarity of Sharia compliance responsibility. Next is the issue on Takaful. Lastly, the supervisory reporting. Now, I've already mentioned the key elements for the supervisory review process. So, if the supervisor concludes that the risk management framework is deficient, is not good, the supervisory authority should have the power to require to the TO to present the supervisory authority plan 33 for remediation, pentambahbaikan, for such deficiencies, and to report on it, the implementation of the plan. So once you want to remedy the deficits, then you have to make sure that your plan must be implemented. So failure to present a plan that the supervisory authority considers adequate to address the matters identified by it, or failure to implement such plan, the satisfaction of the supervisory authority should be the reason for disciplinary action. So that concludes the key elements of the supervisory review process of risk management for Takaful undertaking. Thank you.
Now I would like to present my part, which is systemic risk consideration and Takāful based on IFSB-14. So first of all, what is systemic risk? Systemic risk is a type of document that refers to the transmissions of shock within the entire Takaful sector and other kind of circumstances that give an impact to the financial system. Got it? Okay. This document addresses the issues of systemic risk and describing some elements of TU's operation. What is TU? Okay, before I continue, what is a TU? TU is basically a Takaful undertaking operation. Okay, the operation that could be vulnerable to the systemic contagion and should be paid more attention by the supervisory authorities. So, what is supervisory attention? Supervisory attention is a risk that is not a substitute for the need of an individual TOs. What is TOs? TOs is Takaful operations, whereby the TOs is needed to manage their own concentration of risk set out in the document. Okay, now we move on to Takaful. What is Takaful? Takaful is a systemic risk due to the nature of activity that could be a dominant provider for the Takaful sector. The Takaful operator is systematically important for the market that they supervise, such that, for example, the failure of the Takaful operator will result to the instability of the Takaful undertakings. Okay. Next, it's like a relationship whereby the greater the concentrations of the Takaful sector, the more likely is that one operator will be systematically important to each other. Move on to the risk characteristic. The risk characteristics of other part of financial sector could affect the Takaful system due to the concentrations of investment in view of need for TU, which is Takaful undertaking, is now I mentioned, to invest in Sharia compliant. And based on the slides here, it says that other potential systemically important risk exposure includes the reliance of the sector on other forms of service such as IT systems and also outsourced providers.